Welcome to the Lawyer, Money and You. I'm Roberta Sapphire, an attorney in Sharon, Massachusetts.
And I'm Camille Barron, a financial coordinator and a healthcare advisor, also in Sharon, Massachusetts. And today we have a guest who's been here other times, I'd say at least 2 or 3 times. And every time he comes on, there's always something new to learn.
Right, and he was one of the originators in our first Brighten Up Club for Financial Literacy that we got out years ago.
Right, it was
years ago. And we welcome, he's a certified public accountant.
Yes.
And Alan Lury, welcome, welcome, welcome. But I want, I guess, to know that you're just not a certified public accountant, but to be that, you have to keep updated constantly.
Oh, yes, absolutely.
Yeah.
There's an educational requirement that has to be met at the state level, 120 hours of continuing education every 3 years. And I do a lot more than that because there's a lot to learn. So 120 hours is not enough time to keep up on everything.
You're the first person I've ever heard that's exceeded his continuing education requirements.
Yeah.
I do.
Yes, that's good.
Yeah.
So tell us the latest thing now with the new entrepreneurs and millenniums coming out and starting their own businesses is how should they form their new business? Should it be a doing business? Should it be a partnership, a corporation, a Subchapter S,
Yes,
limited
that's
partnership?
a
We
great.
say go to your accountant.
People do. I mean, they do say go to your accountant, and I always recommend when people are starting out, especially if someone came to me today, I would say if it was a brand new business and they'd never had a business before, to go ahead and basically start as a DBA from day one.
Really?
And the reason for that is that in 2018 we have this massive tax act that came into play, which significantly reduced the corporate rates to 21%. But in order to make it a level playing field for all of the pass-through entities, and there's different various types, there's a DBA, Schedule C, there's a partnership, and there's an S Corp. And in order for them to also benefit from lower tax rates,
Tell us what an S Corp is.
sure,
And a pass-through entity.
it's a pass-through entity. It's a type of pass-through
pass-through.
entity.
And
which,
can you define that for our
Sure,
audience?
yes. A pass-through entity is where all of the net income from the business flows through to the individual's personal income tax return.
Uh-huh.
And corporations now being at 21%, and some people, individuals having tax rates still above 30%, they have to get a benefit as well. It can't just be the corporation. So what is part of this new tax act is that 20% of the net income of the business is going to be eliminated for tax purposes. So if you have a DBA, if you have a partnership, if you have a S corporation, approximately 20% will be eliminated if you meet all the requirements, and those are still being worked out today. But it looks like pretty much 20% will be eliminated, so that effectively that reduces the tax rate the individual is going to be paying on their pass-through income from their business. So today, getting back to the question, if I was starting out a business and it's first time, I would just do a DBA because I'm going to get that same 20% tax reduction as far as the net income.
What about limited liability ones?
Well,
Do
the
they
LLC,
pass
I'm sorry,
through?
I missed that when I knew I missed something. I was thinking, yes. In LLC, absolutely, that's the most new entities that are incorporated today are LLCs, and they're part of the 20% reduction as well. So once someone has that first 6 months and they have some traction and they figure out that they really like what they're doing, then I recommend that, okay, for 1/1/19, go ahead and choose which entity you would like, and be it an LLC. If you're involved with more than one person, it'd be a partnership, or it could potentially be an S corporation. But usually, if someone was going to be an LLC, they might want to, again, take that 1 year as an LLC, and then maybe in the second year, when they really have a true business, they want to start paying themselves a salary, then they make an S corporation
And can
election.
you explain what an S corporation
Yes,
is?
the S corporation allows the individual to take a reasonable compensation on a W-2, and effectively, unlike an LLC and a partnership, the portion of the net income that passes through on their personal return is not subject to Social Security and Medicare tax. So there is a big tax savings there, but you really have to be at the point where you're able to be paying yourself a salary. So it's sort of like the third step after a DBA.
Oh, I think, correct me if I'm wrong, in the Subchapter S, they can't just take the money, they have to do a W-2.
Yes, they actually, yes, you have to pay reasonable compensation. An example I always use is that if someone had a business that had $100,000 of income and before paying any salary, and they paid themselves a $40,000 salary, the net income would be $60,000. Now that $60,000 would pass through not paying Social Security and Medicare taxes, and that effectively on that $60,000 would save $9,000 in taxes. So it's a significant savings that would occur in that situation, and as long as the $40,000 is reasonable, which in that case it would be because it's 40% of the net income of the business, then it's a big tax savings. But you really have to have the critical mass to be able to pay yourself a
Well, you said
salary.
that's reasonable. So
Yes.
40,000 paying yourself of 100.
40 of 100, right? That's
is
right.
reasonable.
It's reasonable. If you paid yourself 5,000, that would not be reasonable. So the issue on reasonableness has not been defined in the tax law. It's only been defined in tax court cases. So it's I would call this a true gray area of taxation. So as long as someone was paying themselves reasonable compensation for the work that they were doing in their industry, based upon the revenue level and the income level that's being generated from the business, they're fine. They're okay. And they're saving a lot of money. Now, there is a downside to every, upside, there's a downside. And the downside, of course, is that down the road, you have not paid in as much into Social Security and Medicare as the individual who was a LLC, who was not an S corporation. So when you go to retire, your monthly check will be a lot less than the person who had paid into the system. So that's the downfall of that. But the issue, of course, is you look at the time value of money. You have that extra money to work with now to build your business versus what's going to happen, and who knows what's going to happen with Social Security, because we all know that is running into a solid brick wall in about a dozen years or so, and something's going to be fixed at that point. So, whether or not what you decide to do may not. What you decide to do today may be changed in a dozen years based upon what happens with Social Security.
Right.
So it's you have to think about the here and now rather than sort of
Right.
what's going to happen in the future.
Now, can we switch gears and talk about the person, the individual who
Sure.
files taxes?
Yeah, I mean,
So there's been some significant
sig-
changes that affect individuals
significant changes,
and families.
Yeah, right. Basically, the tax rates across the board have been lowered from 2018, a point, 2 points, percentages, 3 percentages in some cases. So it's not huge reductions in tax rates. Really, what has happened is that for individual and for a family, the standard deduction has been increased significantly. So for an individual now, it's $12,000, $24,000 for a family. However, again, the tax code is written in taxes are basically on one hand you give, on one hand you take away, and for the individual, there are some significant takeaways this year. I'll start with the first one, especially in Massachusetts, eastern Massachusetts, where you have a number of people who buy multi-million dollar homes. Previously, if your mortgage was $750,000 or less, you'd be able to deduct the full interest on your primary home. Now, beginning with homes purchased 1/1/18, that number has been increased to $1 million. So if you purchased a home for $1.5 million, which is not uncommon price today, if you look in the newspapers, you would have to, if you had a mortgage that was in the $1 million range, $250,000 of that interest payments that you were making on that mortgage would not be tax deductible. Additionally, this is another issue which has smaller ramifications, but affects more almost everyone. People, of course, with the appreciation in their homes, have taken out home equity lines, and home equity line has a limit for interest deductions up through 12/31/17 of $100,000 home equity line, and you can deduct all the interest. Now, a lot of people use that money to buy new cars, to pay for college tuition, and you could still deduct the interest. Now, effective 1/1/18, you can only deduct that interest if it is truly used for home improvements. So if you're going to build, put on an additional bathroom, additional bedroom, whatever, that is a legitimate reason. If you are using if you're using your home equity line to pay for your children's college tuition, you're not going to be able to deduct that interest.
And how will they be able to verify?
That is the $64 million question, because I have no idea how they're going to be able to verify that.
Didn't you used to be able to deduct the tuition anyway as an expense?
Well,
Can you do
in
that, or they don't do
certain,
that
yeah. I
anymore?
mean, you could still deduct this small amount of tuition deduction. They didn't touch the tuition deduction, nor did they touch the tax credits, which is very small. I mean, and the phase out for individuals, it's effectively such a small annual taxable income that and the amount that you get back per student is only $2,500 on a tax credit. That it's not much, considering private schools are well over $60,000 a year in most cases.
But getting back to these homes for $1 million
Yes.
and more, don't they still have to be in a certain class to buy a house for $1 million? A lot of people can't afford $1 million.
Yeah,
They're still
yeah.
looking for the 300,000 range.
Right, and those homes are fine. I mean, they're going to still they're well under the 750 mortgage, and there's no effect there at all. The effect, which is really the biggest effect that in this tax act, which really was effectively to make up for the years of large benefits that people on the East Coast and the West Coast were getting, that were not being utilized or being able to be utilized by the people in the Midwest, the other parts of the country, is the change now that has limited the amount of deduction for taxes, for state taxes and real estate taxes and excise taxes on your automobiles. Beginning this year, you're only able to deduct $10,000 in total as far as an itemized deduction for those particular expenses. So
In total?
in total,
So
that's
state
it.
taxes?
State taxes, property taxes, and excise taxes. So an easy example would be if you paid in $5,000 of income tax, and your house tax, your home taxes are $10,000, which is, a lot of people pay that amount in Massachusetts in property taxes,
Oh,
and they
yeah.
might have $1,000 in excise taxes. That's $16,000. Well, they're limited now to $10,000 on that.
So how do you get around it?
You don't get it.
Any
You
no
don't.
getting
there's
around
no
it?
getting around it. The
No
way the
putting it in
government's
something
saying,
else?
the government is saying though, is now if you're a married couple and you're in that situation, well, we've given your standard deduction is now $24,000, which is significantly higher than it was in the past. So effectively, which is not true, we've sort of offset this reduction in taxation by, on the other hand, giving you an increase in your standard deduction.
And you say it's not true.
No, it's not true, because if you take people if you took people in the town of Sharon, for instance, they might be in the $20,000 range just on those three items that I mentioned, and they're going to be limited to a $10,000 deduction, so the deduction is going to be cut in half.
Can you put it under repairs and maintenance?
No, I don't think so. That's
Hide
not where
it
it's
in
going to
something
go.
else?
No,
I don't
no.
think the IRS watches
No,
the show.
yeah. But the other, again, on the other hand, which this tax act has helped a lot of people, is that, again, this is geared towards the true middle class income, lower middle class income. Is that in the state, if you qualified in the past for having children, the actual tax credit for children under the age of 17 was $1,000. Now that's been doubled to $2,000. So if you have,
So would you adopt children under certain age?
I guess you could. You could. That could be a tax plan, but you're not. That you'll get the tax credits, but I think it costs a lot more than $2,000 a year to
adopt a
to
child.
adopt a child.
This is you've got to be kidding. But I remember years ago. I'm talking many years ago, probably 40 or more years ago, where they didn't have to put the Social Security number of your child.
Yes.
And this girl who worked in the office, she said her father has these extra children on his tax return. And he did it for years.
Well, that's back in the days
invisible
before they
children.
before they verified things. Now,
Yeah.
the one thing you have to give the IRS credit for today is that they verify everything. If they receive something from a third party and it doesn't appear on your tax return, you get a form which is called the CP 200 from the IRS. And what it basically does is it basically says somebody said you had this amount of income on your 2017 return and you reported 0. So you need to verify that, and they then come up with a suggested increase in your taxes, and you need to figure that out. So that's when my phone rings. and often depending upon the person, I know in almost all cases they forgot to give me documentation to include in their tax return. So, that's what happens. You try to get penalties waived in those cases, but if they're repeat offenders, which in some cases they are.
Well, what about the Subchapter S? If somebody put their property in either a Subchapter S or a corporation or any entity, can that entity take off the full amount as regular expenses?
If it's used for business purposes, that's the whole idea. If you can't take your primary home and put it into, well, I guess you could take your primary home and put it into an LLC.
And have it as a business property.
If it was a business property, absolutely. So this deduction for interest does not affect, or property taxes does not affect if you own a 2 or 3 family investment property that you are that you have as an addition to your your primary residence. Plus, if you have a vacation home, that interest is still deductible as well.
Okay, so what we should do? Tell me if this sounds like a good idea. She deeds her property to me, maybe just with a remainder.
Really?
Yeah, with a remainder. With a remainder.
Is that what you had me sign the other day?
And I rent it to her.
Yeah.
And I take it off, and I do the same with mine.
Yeah.
And then we both get deductions that way. And then you figure it out afterwards how you get your own property back.
In theory it works.
That theory works, huh?
In theory it works because of the fact that you would be you'd have the deductions, and one would have the income, the deductions, the other would have income in the other property, and the deductions.
They both would make out. I bet you people do that.
They may do that.
I mean, if I think of it and I'm not an accountant.
I don't think they've had the chance to think of it as of yet, but I think they will shortly. They'll
You
start
like
thinking
that
about
idea?
That. Yeah, I sort of like that idea. Yeah, I don't want my clients coming up with that idea. But
well, they could deed the property to you,
yeah,
and you could rent it to them.
Right.
And then you could just have maybe an unrecorded deed back to them or something like that. I'm not sure how that would work.
You've got to be kidding.
I'd like to keep my CPA license for another 35 years.
Oh, okay. No, that's
Which I've
good.
had
No, you're
35
good.
years already.
Well, we think you're wonderful.
Oh, thank you.
Anyway.
So in terms of looking at the big picture about the change in tax law, would you say that, do you think businesses profit more from it, or individuals?
Well, I think there's the businesses absolutely, because of this 20% reduction on this pass-through, on the pass-through entities, and the C corporation be at 21%, plus there's going to be full write-off of assets that businesses purchase, 100% depreciation write-off in the year of acquisition.
Really? No
Yes.
matter how much? Well, that's big.
There is an increase in what's called Section 179 write-off, but it's
I
so
know that
much that in
section.
almost
That's a
almost
common-
everyone, any small business will
I
be
have
able to
a
write
question on
everything off.
depreciation.
Sure.
Now, when you go and sell the property, do you have to add back the depreciation?
Yes, you do.
So-
That's a shock
Yeah.
to a big shock to people. I've been
Yes.
through this experience.
You get it off year one, and then you have to add it back
Yes,
on.
that's
not
exactly
very helpful.
right. Yeah, no. In a rising price of business property, I have had. In fact, this year, I've had a client. An interesting story that he had a piece of property, business property, that was sold, and he had a significant capital gain, especially after we added back in 15 years of depreciation. So under the tax law, which has been narrowed specifically to these types of transactions, is that you can actually go out and find another piece of property similar, invest the purchase price, invest the sale price, effectively the sale price of the property, and defer your gain, and that's called a 1031 exchange. And I've had clients do that several times.
Aren't there particular people who just do 1031 exchanges?
Yes, there are.
I mean, you have to have it in an agency.
It's a very technical area, and I have been working with one firm in particular that is very good at it. And
Well,
in
that's
this
a good
case, they
idea.
saved my client a significant amount of money. His tax money has been deferred. So that's a whole 1031 exchange. It's interesting stuff because of the fact that people do not realize that, again, that the government gives on one hand, allowing you to take depreciation when it comes to real estate, business real estate. On the other hand, when it's time to sell, it all has to come back as income.
Do you have to do that on like machinery? How do you?
No,
it's-
same thing with
it's not-
machinery. Effectively, if you go ahead and sell machinery,
Well, I mean, it falls apart. What
yeah,
happens then?
if it falls apart and it's fully depreciated, then effectively the depreciation is recaptured at the point
Really?
of disposition. If you were able to sell it, for half the value, half of the depreciation, then you'd only have to pick up half of the depreciation.
I have a question from
Sure.
some of our viewers have asked this question.
Oh, yes.
If you're collecting Social Security retirement benefits,
Yeah.
how does the taxation work on those?
Yeah, that's a good question, and I think that's something that Social Security, taxability of Social Security benefits is a great example of why, in my mind at least, people are very much, today everyone likes to invest in Roths, and the
Yeah.
reason for
Yeah.
Roth, investing in Roth is that everything that grows in that, it grows tax deferred. And when Social Security first came out, there was no discussion that Social Security would ever be taxable. But about 20 years ago, all of a sudden, Social Security
Taxable as
became
income.
taxable income.
You pay twice on it now.
You pay twice on it. So what happens is that if you have income, other retirement income, if you're working part-time, you could be taxed up to 85% of the Social Security that you receive. And I see that quite frequently, so that if someone's receiving $30,000 in Social Security, they're paying, $26,000 of it is included in their taxable income. So you really have paid twice on that.
That's like if you've got to be kidding. And another you've got to be kidding, because we're into you've got to be kidding now. I mean, that really went fast. Is that years ago, I remember my father died in 1962, and Social Security contributed $250 towards his funeral.
$255.
Oh, $255?
Yes.
Oh, they got away with
No.
calculating.
It's always been $255.
And so it's still $250.
Still
Isn't that
$255.
amazing that that's never gone up?
No, I don't expect it to.
Really? I mean, I find that absolutely amazing. That's when people, if you made $1 an hour, you were doing good.
Yeah,
Isn't
that's
that
right.
amazing?
That has not. Your burial fee. Yes, that the contribution they're paying to.
Better
yeah.
off just throw them out the window or let them flow with the wind.
Yeah.
More and more people are getting cremated now.
Yes,
Probably.
yeah, they are. Well,
Yeah.
that's because it's cost.
Yeah,
It's a
isn't
lot
that
more
something?
inexpensive. Yeah, it's a
Isn't that
lot more.
something? Well, anyway, we're in You've Got to Be Kidding. This is our You've Got to Be Kidding
Oh,
bag.
boy.
Oh, I wanted also to say, we have our police officers are our friends, and we have an ongoing coloring contest, which our team member Michaela drew this by hand.
Oh.
very nice.
Yeah,
Very nice.
go ahead, you said you had
Yes, so
something.
this is, this
You got to
happened
be
this
kidding.
past year. So we got a bill from the IRS saying that we didn't pay our taxes. Okay, now I know that we paid our taxes, and I even see that it was debited from the bank account, okay?
Yeah.
So I called the IRS, and I finally got to someone, and I asked, well, why does it say we haven't paid our taxes? I have
Oh,
records
wasn't
right
a
here.
scam?
No, it wasn't a
Oh.
scam. This was a letter that came from the IRS. And to make a long story short, the representative from the IRS said, oh, I see why. She said, you filed it under your Social Security number, and since your husband is the primary on the Social Security, on the IRS tax filing, we both, we filed jointly
Yes,
though.
yeah.
That wasn't right. I said, well, what do you mean it wasn't right? No, it has to be on the primary's Social Security number. Okay, well then why wasn't I sent some sort of a notification? Since you took the money, you did take the money.
Yeah.
And why wasn't I sent some sort of notification? Oh, well, we don't do that. It's up to you to know. So I said, okay, all right. So then I decided I would go online and pay I would pay the tax. And I found out that for some reason, I couldn't get on under Jim's name, okay? I know that he had an account because I had created an account for him, and I had an account. I showed on my account that it was paid, but I wanted to be able to pay it under his, right? So hours were spent, and every time that you know how you fill out that
Yeah.
first page with
Yeah.
all the personal data?
Yes, yeah.
It kept saying, this doesn't match what we have in our records. This doesn't match. Everything is right. So finally, again, I had to call the IRS and wait 65 minutes on the phone.
Yeah. Oh, you got to be kidding. I know you're not kidding. I
I finally got to
kidding.
somebody there, and he says, yeah, I see what you mean, and I'm not sure why this is happening. Well, why don't we go through it item by item? And I will,
my God.
you tell me what you're entering, and I'll look here to see what we have on record. So we went through every item, everything matched, except the date of birth. The IRS had the date of birth 1 year off on Jim's record. And I'm not kidding. I am not kidding.
But in your filings, you didn't write when you were off. They just had when you
Yeah,
were-
and
Oh my
so they
God.
said the only way to correct it is Social Security. And by the way, when you call Social Security, you also have to wait usually about an hour.
Okay.
But imagine that they've had
That's
on his records
unbelievable.
a 1 year wrong, a 1
For
year
years.
off. Yes, but for some reason it never came up. They never said there was any discrepancy.
Actually,
That's to be
thinking
kidding.
about that might have an effect on his Social Security benefits as well.
Oh.
Oh,
Yeah.
Oh.
Yeah.
wow.
Well, that's
Yeah.
a good way to end.
Yeah, we'll have to. I didn't think of that.
That's
Yeah.
like some of these warranty services, which I'm having a problem with. They give you one number to call, they keep you on the phone, and they give you the other number, and then they round and round and round and round, and
Okay,
and
we're
that's
getting the
it.
word. It's time to wrap up the show.
It's time to wrap up. Boy, that
Okay.
went by fast.
It
Yes,
did.
it
Now
did.
listen,
Well,
I'm gonna say to you, I would love to have you come back. This time we'll talk about taxation of retirement benefits.
Sure.
And talk about Social
Ooh.
Security, but also, accounts, IRA
Yeah,
and so
yeah.
forth. And what can you do to minimize, or
Yes.
to at least reduce the amount of taxes?
Yeah.
Like the required minimum distributions and all that.
Distributions, right.
You don't like my suggestions?
What's that one?
Well, what you're not supposed to do.
What you're not supposed to do? No,
That's okay.
we can do those under the table. We have a
Yeah.
nice table over here.
Yeah.
We'll put them under there.
Yeah, we'll put
Okay.
them all under
So,
the table.
It's been great. It's
Yes.
always
Yes.
wonderful because
Wonderful.
we always
Bravo.
learn something new when Alan is on the show. And
he
you know
knows
what?
his
You
stuff.
mentioned that you really do more than you need to in terms of continuing
It
to add.
shows up.
And it does show. It really
Thank
does because
you.
you have this at your command.
Yeah.
Yeah.
And we really appreciate
Oh,
you being
yes.
on the
I
show.
enjoy it every time.
Yes.
Yes.
Yeah,
And
wonderful.
to our viewers, if you have questions about anything to do with the new tax
Yes,
law,
send it
I'm
to
sure
us.
that Alan Lury would be able to help you understand it.
Oh, it's Lury,
Yes.
not I-E.
And
Okay,
we
remember.
would love to hear from you if you have questions about this show, any other show, or any feedback whatsoever, because we depend on you to help us to figure out what's most important. So remember, please let us hear from you, because remember, this is your show. The law, your money,
and you.